Hey everyone, it's good to see you here. Welcome to the session this morning. We'll obviously just wait for a lot more people to join in, but good to see you everyone. Hello Shehan. Hey Payal, I can see you in the bus. I think that that is. JJ, always good to see you, my friend. Aaron's video doesn't look like an Aaron, maybe Aaron's partner, I'm not sure. Um, Good to see you guys today. We'll just wait 30 more seconds before we kick into gear. All right, there you go. Cool. Hello, Robert. Good to see you here all the time. Sabby, driving and doing the Zoom. Hopefully, you're doing that safely. Lena. Okay, let's get into it. We've got quite a number of people here. So I'll just start as per usual, by going through the disclaimer. So by continuing on this call, you agree that any information provided by me on this call or any call is provided as general information and for general information purposes only. I have not taken your personal and financial circumstances into account when providing information. The information is not intended to imply any recommendation about any particular financial product or class of financial products and should not be reasonably be regarded as intending to have such an influence. The information provided must be verified by you prior to acting or relying on the information by an independent professional advisor, including a legal, financial, or taxation advisor. The information may not be suitable or applicable to your individual circumstances. All right, let me just admit everyone else on the call as well. Okay, thank you for coming, everyone. And like I always say, congratulations to anyone who's bought properties over the last week. I think I had like maybe 4 or 5 of you email me. I'm sure there were many more that actually bought. So congratulations. And I always love to hear about those deals. So keep sending them through. The purpose of these sessions is to support and guide you so you can get the best results from the course. And today we're going to do Q&A. So even before we get into it, if you have questions, I'll just preempt things. Please open up the Zoom chat box and put in your questions there because the whole 60 minutes I'll dedicate to just answering your questions. So please do ask lots and lots of questions. And of course, where are my notes gone? Okay, here we go. Like I always say, all my clients are welcome to attend these sessions. And if you're watching the recording, thank you for doing that too. They happen every Tuesday at 8 a.m. Australian Eastern Standard Time or Brisbane time. And if you're new, as you may be, I'll just share my screen right now and take you through two things. The first thing I'll take you through is the community forum. So this is a community forum, and when you log into the course, you'll see the course and also the community forum, not to be confused with the Facebook group, which is public. And so this is incredibly active. There's thousands and thousands of questions and answers in here. And I really do encourage you to, I still get lots of members sort of, like stuck or spinning their wheels. And I've noticed that they haven't actually asked any questions. So please ask lots of questions. There's a lot of answers already here, like thousands on demand if you use the search box and put in key terms. But if you don't want to do that, please just ask a question. We're genuinely here to help you. And the other resource I want to bring to your attention, as I always do, is where all these mentorship calls are archived. So this is the wrap-up section of the course after week 6. And every week, all the archive recordings are placed here. So for example, last week, the 24th of September, we had one of our members, Imish. He shared how he successfully bought 2 WA properties in 2 months after 4 failed offers. And so he actually very kindly went through his 4 failed offers as well and why he failed. So if you're, failing in your offers and you're like, agent's not picking up the phone, agent's not, like reciprocating, I don't know how to get a deal over the line, then this mentorship call, might just be the thing that gets you, unblocks you. And then you can also reach out to Imish by tagging him in our community forum, which I just showed you before, and asking him questions. And so that's really how to get results. Previous to that, we had Prashant share how he bought 4 properties quickly in under a year with, in his own words, like relative ease. So like if you're not finding it easy, if you're finding it really difficult, then perhaps it's a good idea to watch this session and then reach out to Prashant and see how he did things and is doing things differently to perhaps you are. Previous to that, we had Reese take us through how he bought 4 properties in 2022, or since 2022, and how he's targeted dual occupancy so that they're positive cash flow, even in the kind of current higher interest rate environment, so that he can afford to keep buying. And then on a quarterly basis, as you guys know, we go through listing suburbs over 500 and under 500K across Australia. So perhaps if you're new to the course, it'll be really useful for you to go back and check out these recordings from August, to make sure that you're in the right direction, or it will at least instill some confidence in you that your analysis is kind of being validated or confirmed by my comments and insights here. We've went through more than 150, I think, suburbs across these 2 sessions, so plenty of suburbs for everyone. And yeah, I won't bore you, but there's literally hundreds of other mentorship calls as well. All right, let me stop sharing my screen. Just admit everyone else onto the call. All right, guys. So the way that we'll work today, like I said before, is I don't have any guest speaker or member or anything like that. We'll just do straight Q&A. So please open up the chat box and ask your questions, and I'll make an attempt to go through all of them. You can ask about anything. This is a really good opportunity for you. Just ask about anything, as long as you've, of course, done that part of the course. Otherwise, I'll just be repeating what's already in the course. Of course, if you're asking about a particular suburb, I don't know all suburbs off the top of my head. So it's better if you ask specific like data question, and then I'll be able to help you answer that. We won't be able to go through an entire analysis of a suburb. And lastly, please don't be shy. I'm genuinely here to help you. So yeah, please make the most of this opportunity. All right, so let me just admit everyone else onto the call, and let's get going with the question. So far we have 4 questions. So I really encourage you, please ask lots of questions. We've got more than 100 people here. All right. So, the first question Arjuna is asking, in DSR, does days on market mean property sold from the day it listed to settlement date, unconditional, or deposit paid? So different data websites have different definitions. In DSR, I believe it's to unconditional. And so that's why it's not like 1 or 2 days or 3 days, because that definition, for example, if you look at CoreLogic data, they say that in Perth right now, the average days on market is about 8 days. Now, you won't find that on DSR, because in CoreLogic, they look at it as when the first, contracts are exchanged effectively, whereas, DSR looks at it as unconditional. But the absolute value, doesn't really matter. It's the definitional value that matters, and the trend, as stated in the course. All right, so the next question is, will the current negative gearing and removal of capital gains discount discussion affect investors from buying further if implemented? Let me know, guys, maybe leave a yes, or maybe give this question a thumbs up if this is something that's on your mind, and you're sort of worried about it or thinking about it. I have done a really comprehensive video that I just posted on YouTube. I think it was like a few days ago. So that has, it's like a 20-minute video. I basically answer this question, but I want to answer it here again for your benefit. There's, I could talk about this for like an hour, but I think there's different things to consider. First is the removal of negative gearing. So the removal of negative gearing is obviously going to shift some sentiment. There's no doubt about it. It's going to shift some sentiment away from the property market. And that's simply because most people are simply uneducated. Most investors, there's, I think, 2.3 million property owners in Australia for a population of 27 million. That's quite a high percentage. Most of them, they're just not educated. A lot of them might have kept a house after they've upgraded or downgraded, and therefore they're technically investors, but they didn't go into it with that sort of exclusive purpose. So a lot of these people, I feel, will be a little bit frightened or put off by the fact that negative gearing, if it doesn't exist in the future. But I think the reality also needs to be understood where more than 50% of property investors in Australia don't even negatively gear. I mean, as you guys know from week one, we make the most of negative gearing in the short term. As, for example, if you buy a property today, most of you will be having, slightly negative geared properties, let's say $5,000 negative or give or take. And of course, I'm assuming you're not buying it to lose $5,000 and then get, let's say, $2,500 back in tax. It's great, and we're modeling that in our portfolio budgeting tool, but that's not the reason we're investing. And for those of you who've been in the course for many years, or even since 2022, you would have bought a negatively geared property in 22, and then fast forward 2 years, rents have gone up like $150 or $200. And now it's not negatively geared, or it's less negatively geared. And so negative gearing is just a moment in time sort of thing. And so if you're following the philosophy or thesis that we follow in this course and that I've followed in my own investing, which is high growth and also high yield, not just quote unquote blue chip properties in Sydney, Melbourne, Brisbane, because we think they grow more, which they don't. We're actually buying 5, 6, 7% plus type properties. Therefore the negative gearing is just a short-term outcome. It's not our strategy. But like I said before, most people don't have this strategy in property investing because they don't know that it exists. And so there will be a certain sense of sentiment leaving the market. Now, I can't predict exactly how much the property market will go up or go down, in 1 year, let alone 5 years. But like I shared in that YouTube video, there's been studies done by the University of Sydney, University of New South Wales, Gartner Institute, etc., that have modeled these things out. And of course, all modeling has to be taken with a grain of salt because it's filled with assumptions. It's just the nature of the beast. But they're suggesting no negative gearing would mean property prices drop by about 1.2%. And then over the medium term, they just carry on as per normal. So, if you subscribe to and if you believe and if you have faith in these institutions, and the RBA actually validates this in some of their papers. You can find them yourself on their website. Then it suggests that negative gearing isn't it's a political football, but it doesn't really contribute to a housing bubble or conflated house prices. Negative gearing exists in many places around the world. I think the bigger one is obviously capital gains tax. Now that directly implements our strategy, which is our exit strategy, where in whatever 10 years, 13 years, 15 years, whatever the modeled year was for you in your strategy quantum wealth creation tool, we're really relying um, on getting rid of our debt by selling some of our properties in the future. Now, right now, we're happy that we get a 50% CGT discount. If they get rid of that, which I don't think is likely, they may reduce it to 25%, but once again, I don't even know if that's likely. That could have an impact in terms of our strategy. And so therefore, your modeled year would go further out. Or you might say, look, I'm not going to sell. I'm just going to enjoy the passive income, although it's less because I haven't retired debt. Or we might need to think laterally at that point and come up with some other strategies or methodologies. But I think that's I think that's almost like the bigger influence in terms of the strategy that I teach. But if you think about it, if you remove or reduce capital gains tax, there's already residential real estate in Australia already has so much friction in terms of buying and selling costs compared to other parts of the world because we have huge stamp duty, we have capital gains tax. Other places don't even have capital gains tax or stamp duty. And so property is a much more liquid asset overseas, but in Australia, it's not. And if they reduce or eliminate capital gains tax discount, then it will become an even less liquid asset because even fewer people will want to sell their property. Because who will want to sell if you have to pay all of these gains to the government? Why not just refinance and take advantage of the capital growth by extracting equity, right? Instead of selling. Or even if you don't want to extract equity, why sell? Why not just keep it as a sort of golden goose that's giving passive income or at least going up in value as an asset? So I think removal of capital gains tax discount will make the property market less liquid, more sticky. There'll be even less supply on market, and you have to be cognizant that right now in 2024, supply's edged up a little bit versus last year, but it's still like way down versus 5 years versus 10 years ago. And so I think that will really harm the property market. And of course, as we all know from having done week 2 of the course, the less supply you have, the more property prices have a floor under them, the more property prices go up, provided demand is there. So I think, I talk about in that video on YouTube how I'm actually a little bit in favor of getting rid of negative gearing. But I think the nuance is that they should probably get rid of negative gearing for, let's say those people who negative gear to the tune of hundreds of thousands, or those that have more than 10 properties. The number one profession that negatively gears the most is surgeons. All right, they can probably afford to cop that, reduction or removal of capital of negative gearing. The professions that negative gear the least or not at all are your teachers, your nurses, your just sort of everyday professions. So I think they need to be very careful of implementing a policy that actually further eliminates the middle class and creates further inequality. Anyway, those are some thoughts. I've talked more about it on YouTube, but that's a great question. And of course, I'm not the only expert, quote unquote. If you guys have thoughts on that, put them in the chat as well, so that other people can benefit from your thoughts. Um, Next question. Noticed that a lot of properties in Melbourne, including townhouses, are going on auction. Why is this the case? And any tips on how to negotiate in auctions? Um, so Melbourne is like auction, it's like the capital city for auctions. In Brisbane, they're more sort of reserved for more premium areas. ACT, they're common as well. Sydney, yes, in all sort of spectrum of house prices, but in Melbourne, they're like the most popular. So as soon as you see some suburbs or some markets, start to heat up, that's actually and there's auctions that are prevalent, that's actually a sign that, things are actually starting to simmer. The pressure is building up. In terms of how to negotiate in auctions, I actually cover this in week 5 of the course. So we always try to get that property before auction. Now, of course, you always have to make sure you get a building pest inspection done, because an auction scenario means that it's unconditional should you win the auction, as I say in week 5. But I will always try to buy a property before it goes to auction. So you might say, okay, to the agent, much like we try to buy properties before they go for their first open home, right? To reduce that sort of amount of interest and competitive demand, or other people being interested in the property. Before it goes to auction, you might say, look, you just give a really good offer. You just put your best foot forward. If you think the valuation is, I'm just making it up, 500,000, you give 500,000, or you give 510 or 520,000, whatever the case may be, per your strategy. And of course, you have to get your building and pest inspection done ahead of that. And a lot of the times you'll be surprised, the seller, they may not be completely sure how the auction will fare. Maybe the auction will fail, especially right now. Melbourne's not hot, right? Some areas, like I said before, are simmering, they're improving, but they're far from being, boiling point or hot. So in the vendor's mind, they're like, okay, the selling agent has recommended an auction to try get the best price, but what if only 2 people rock up? What if it's raining and no one comes? And then property becomes stale after it's gone through a marketing campaign, an auction, and no one's bid for it. And so if that's on the back of their mind, they sometimes take an offer and accept it before the auction. So you always try to do that. And you can speak openly with the sales agent to see how forthcoming the vendor could be for that. And in an auction scenario, I've taught you how to do that in week 5. So I won't cover that again, but it's effectively, it's just a constant bidding, upbidding, 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 being confident scenario, as opposed to kind of, lurking in the background and coming out in the last moment. That, in my experience, doesn't really work. So look at week 5 for more details. Next one, I followed the suburb selection process and made changes, including cooler suburbs. I found only 4 suburbs. Do you think I'm doing something wrong, or the market is really different to what it was before? I think you might be perhaps missing something or doing something wrong, or perhaps like you're being too strict with your criteria. Maybe your yield is like, I don't know, like 7%, in which case there's not many that are coming up. So it's hard for me to tell. But in August, I went through over 150 suburbs, including many that were cooler. So maybe go check those out. I just reintroduced them at the start of the session in the call today. So please go to the wrap up section and you can check them out. Bile, hi PK, current conundrum. Melbourne suburbs that are showing a cluster of strength and meeting our coolest suburb metrics are still showing lower yield of 4.5 to 5%. If a choice between regional Victoria versus Melbourne Metro, which way should I skew in my search, as I need about 5.5% yield for my next purchase? So I think, property investing is all about firstly risk mitigation, and from the platform of being safe, then taking an educated risk. Risk equals return, but it should be calculated. It should be informed and educated. So if you're telling me that as per your household budget, if presumably you've used the tool that I provide in week 1, you need a minimum of 5.5% yield, then that's the platform that you shouldn't compromise. At least that's my school of thought. I don't ever want to have to sell a property because it's draining my household finances or it's causing me stress at night because of a cash flow issue. So that's your platform, right? That's your safety. So in your situation, if that is true, what you're saying, then you would have to skew by definition to a place like I mentioned some of the suburbs in Bendigo as an example. In the August mentoring calls. So yeah, that's how I approach it. Aaron, what do we do if the 18-month building approvals does not show some of the shortlisted suburbs on the website you've shared? So oftentimes, Aaron, um, the suburbs are subsumed into neighboring suburbs. So, on a map, there might be like 5 suburbs on Google Maps, but the building approvals data might only be available for like 3 of them or 4 of them or 2 of them. And that's because the other suburbs are already included or contained in those adjacent ones. So in this case, I also answered this question in detail in the FAQ reference sheet for week 2 in the download section. There's a big paragraph on this. But in short, basically you just look at those neighboring suburbs. And you can look at many of them. You don't just have to look at 1 or 2. You might consider, like half a dozen around the suburb that you're looking at. And if all of them are within threshold, then yeah, then that's fine. Ravi, morning, PK and team. Most of my suburbs I've narrowed down have grown between 35 and 50%. Will it grow further? So that's within our threshold. So, that threshold is there to reduce risk. When a suburb grows more than 50%, 60%, 70%, even 80% in the last 36 months or 3 years, that doesn't mean it's not going to continue to grow or that it couldn't continue to go up further, but there's a higher likelihood that it won't. And that's because of reversion to the mean. The biggest thing that stops or prevents or puts the handbrakes on future price movement is historical or recent price movement, because it really prevents that affordability story. It really puts a handbrake on affordability. Like I've been wrong many times before. I think I remember in 2021, I think 2020 or 2021, something like that. I didn't think Hobart would have much more legs, even though a lot of clients bought there, including myself, all the way back in 2015 or 14, I can't remember. And I thought it wouldn't grow more because it already basically doubled, but then it continued to go up. So this metric is there to reduce risk. And so if there are suburbs available that haven't grown more than 40% or 45%, you prefer those, or then, up to 50%. That's how you think about this one. Um, Vivek, hi Pika, on week 2 on cooler suburbs, I'm finding only a handful of suburbs with a favoring trend over the last 6 months. Most of cooler suburbs are either flat or showing decline on prices. Do we ignore all of them? So I don't know which state you're looking at, Vivek, or of course, like your yield and how big your universe of suburbs is, etc. But if a suburb is flatlining, then it's sort of down to your risk appetite and saying, okay, the data is good, but it's not really manifesting in price growth. It could or it could not. Am I okay to buy in this location knowing that short or immediate equity uplift is a higher, it's not a guaranteed thing. If the data is good, but prices are going backwards, you know, that's an area that we then say we don't want to buy in because A, the data might be good, but it might have already grown so much that now prices are going down and the data is shifting as well. So then you'd have to understand like stock on market, days on market, what are the trends in those things. But I basically completely ignore locations where the prices are going down, despite what everything else says in the last 6 to 9 months, like consistently. But if it's flatlining, you might want to monitor it. But there's definitely more than 6 suburbs. Sorry, we have more than a handful of suburbs that are cooler, but that are also rising in value. And like I said before, I went through many of them in August in the quarterly suburb update mentoring calls. Next one. Hi, PK. I'm looking for Townsville area. The asking price is above the CoreLogic max estimate. The problem is the bank valuation. I saw some cases of undervalue. Do you think that the Townsville area is still worthy, even though we need to pay more than the bank valuation? Um, so I think I'll just clarify a few things here. I don't subscribe or agree with the CoreLogic anything really. CoreLogic valuation for anything, use the CMA tool as I've taught you in the course, and make sure you index it. And I've taught you in the course how to index it. We've done many of these sessions, practical guides on how to index as well. But if you're using the CMA tool, like that is basically best in class. And if you send that to your broker, and if you've done it properly, and of course you can email me your CMA tool when you've done it, and I can check your work. If you do that properly, then the bank will value it up. And it's a high chance that the bank, it's almost never happened that the bank has undervalued a property if you've done your own CMA tool and if you've actually sent them that CMA tool, because it's a fact, that they have to if those comparables are real. But where you can get into trouble is when you look at CoreLogic estimates and then like CBA, those automatic bank valuation reports that you can just get online in a second. All these things, the CMA tool is the most important thing. Robert, week 2, 36-month median value growth rate question. I'll base the question on Kincora, however, is applicable to any suburb. Kincora has grown about 30% on DSR in the last 36 months. How do we apply that growth to what maximum we should pay for a property in the market? Kincora 36 months ago, 330K, typical value now 432K, 30%, 36-month growth. How do you work out a reasonable maximum purchase price now before pulling out of that market? Is it just 50% from what that typical value was 36 months ago? Yeah, basically, that's pretty much it. Pretty simple that one, Robert. But maybe it's just a nomenclature, but you're using the term reasonable maximum purchase price. So this 36-month 50% metric is like a decision of whether we're still interested in the market or not, right? Interested in that suburb, sorry, or not. Purchase price is to do with a particular property, and the purchase price, what we want to pay, what we think is a true valuation, is determined by the CMA tool. So maybe it's just nomenclature, but yeah, just wanted to make sure you understood that. Gyan, it is getting very difficult to buy properties in Queensland. These are mostly in hotter suburbs. Is it a good option to buy in comparatively cooler suburbs? 100%. Yeah, I agree with that. And that's why I know I'm always talking about these, the 2 mentorship calls that I did in August that I do every quarter, where I go over the top 150 odd suburbs. But there was dozens and dozens and dozens that were, um, cooler suburbs that I talked about. And I think it's, yeah, if you, uh, some people love to buy in hot suburbs. Like I personally love to buy in hot suburbs because I know that 3 months down the line, I already made $50,000, right? But you really need to have confidence to buy in hot suburbs because you need to be, politely assertive with agents. You need to not hassle them, but you need to be, front of mind. You need to be texting them. You need to be emailing them. You need to be spending time on that relationship building piece. And it's not a part-time job or anything. Like we've had dozens and dozens of members come on, these Tuesday sessions and share how they bought in hot suburbs, how they built relationships with agents. It's entirely possible, but then you actually have to do that. You have to do that work, right? You have to pick up the phone, etc. If that's not your proclivity or inclination for whatever reason, and my advice is always to build that inclination and that proclivity because it will make you money. But if you're not wanting to do that, then pivoting to a cooler suburb makes life easy for you. But of course, it's that trade-off. You are unlikely to get the huge short-term wins, like the equity gain, but that doesn't mean it won't come. Just like, the clients that were buying in Perth at the start of 2021, maybe some of you are on the call today. Back then it was cool, but then fast forward, it became super hot. So cooler suburbs, provided that you do your due diligence, do become hot. But it's just like it's almost impossible to predict exactly when that will happen. So it comes down to how you want to approach things. Pankaj, hi PK, I am in Townsville suburbs, and whatever best I do with PMs and my offers above after CMA, there's always someone throwing much more. What should I do? Yeah, I mean, it depends on the suburb, etc. But I know that the rhetoric in the public these days seems to be that investors are throwing so much money in Perth and Townsville, etc., and boosting prices. Some of that's, of course, true. But really, when your CMA is 400K and then someone offers like 480K, that's not an investor. That's an owner occupier. And there's really nothing we can do. Like if someone is giving 500K for a property that's worth 400K, like you just let that one go. You just like, and that's really the case because prices are rising so much in some of these areas. People who are renting have really got FOMO and they're doing all that they can, beg, borrowing, and stealing, so to speak, to get onto the property ladder because they know if they don't get on now, they'll never get on because prices will be too much for them. They won't be able to get to that deposit. Or they just don't have the serviceability. So it's really owner occupiers that are really pushing up the market. And I would love to have some sort of magic gem solution for you, but when an owner occupier overpays by $100,000, there's really nothing you can do. And so you have 2 options. Use, as many members have come on these Tuesday sessions and shown how they've done, you build relationships with agents and, you just wait for the right one. You wait for the right deal. It might take, like last week, we had Imish. He took us through his 4 failed offers in Perth before he got one right. And he was totally dejected and demoralized, but he just kept going, and the 5th one worked out for him. So that's all that you can do. Or, as the previous person suggested, you just pivot to a different location. Um, the next one is, does following the system for suburb selection work for my own Sydney principal place of residence? If this is the decision I want to find my property in Sydney as I live here, or suburb selection only works for investments. So the suburb selection system and the underlying metrics that are taught, they're like gravity. I mean, they work regardless of investment, principal place, whether, it just is what it is. That's what drives particular suburbs and locations up or down in value. So yeah, it absolutely works. So many people, especially these days, I'm finding are doing, like joining the course because they want to buy their principal place of residence, but they want that equity growth, so that in the future, they can leverage that and like use that equity to start their investment portfolio. Of course, a lot of people rent vest, but other people do it the other way around. Everyone's different. And so, yeah, it absolutely works, 100%. And like in Sydney, I actually went through some Sydney locations. I'm excited to talk about Sydney again. It was mostly under 7 or 800K, like with an investment thesis, because we don't want to be buying too expensive properties. I went through them in August on the mentoring calls. And I think there was a bunch of townhouses, etc. as well. But yeah, you just apply the same principle to a principal place of residence. I would say though, the system sort of breaks, I'll just be completely honest, it's not as accurate when you start getting into like 3 million, 4 million, 5 million type price range. Because at that end of the market, there's far fewer like listings and sales. So the data isn't as the integrity of the data isn't as robust, and there's a lot more emotion involved in that market. And the other thing as well is that it only takes like one property, like let's say in a suburb, there's like a $10 million sale, then the median jumps, even though that was clearly like a very unique property with on the water or something. So the data isn't super relevant for like very premium properties. I don't know what type of property you're looking to buy, but under a million, under 2 million, it's completely fine. Miss Love, hi PK. When looking at the bushfire risk at the range in Rockhampton, the main risk in this area is from the botanical gardens, which rules out a lot of the suburb according to the map on the Queensland website. Would you consider this enough of a risk to rule out all of this area? So yeah, I mean, typically I have never bought in a bushfire zone, regardless of whether it's like a little scrub or botanical gardens or whatever. Um, and I know many members have, like everyone's kind of different. If you're looking at the botanical gardens, like on Google Maps or property managers gone there and they're like, there's no big trees here. It's like roses and like grass, and there's no bushfire going to occur here ever, right? You might say, okay, well, yeah, I'm happy to override that. But then if that's the case, you just probably want to get on the phone with the council and just see if they have any plans for the botanical gardens, if they're trying to like, I don't know, make it more lush or whatever. That's one sort of uh, stage gate in the decision-making process. And the other would be calling the insurance company and understanding whether they put on an exorbitant premium because it's in a bushfire zone. And if those two check out, then you might say, look, yeah, I understand the context, why this was in a bushfire zone, but all there are is a bunch of roses or whatever the case is. Um, Vishal, good morning, PK. Any key point to be considered while buying investment property between the months of October and December? That's a good question. I really like this period of the year because especially towards the end of the year, like November, December, some people who really want to sell, they want to sell before the holiday period because like I always say every year, from Boxing Day, sorry, not Boxing Day, Christmas Eve, to Australia Day, like end of January. A lot of agents don't work, there's less listings. So if you want to be buying a property in the next 4 to 5 months, it's better just to get it done well before Christmas starts. And also, sellers or vendors have the same sort of thinking. If they don't sell by Christmas, they're probably not going to sell in January because a lot of agents don't work, less people are interested in property, everyone's on holidays, etc. So there can be some great deals. I always talk about how I bought one in Newcastle like many years ago, I think almost 10 years ago, on Christmas Eve, and I got it like I think it was like 40, $50,000 less than what it was valued at. And that's just because the vendors, they didn't want to mess around for the next month. So they weren't desperate, but they were just like, let's just do it, like kind of thing. So yeah, it's a good question. Um, Hurry, just signed up last week, finished the course in a week. I still have cold feet doing it all by myself. Any tips on how to get going with it? And then Pyle is answering, take action is the most important step. Follow the steps, one foot in front of other. That's some great advice there, Pyle. Yeah, Hurry, I would echo the same. Attend these sessions. Like I said at the start of the session, there's literally hundreds of members who have shared their stories on these sessions. They've shared the addresses, what they really struggled in, what they succeeded in. You can reach out to them as well. And you can also do it as a mock exercise. So if you're like, oh my God, I don't want to sign a contract, I'm too freaked out about that. What if I get it wrong? Just go through the process as if you were like about to do it, but then don't actually do it. So you can do your suburb selection, you can do your property selection, you can start calling agents, you can start negotiating on a deal, and then you can just pull out. And then just by having gone through that process, you'll be like, okay, I can do it. The only thing left was to actually sign on the paper. And of course, you can always email me properties when you find them, and I can help you vet them. Like you can ask me which factors you've tried to analyze but you weren't sure about. And so with hopefully my input, then you should be gaining a lot of confidence. Next one. Hi, PK. After you mentioned not to buy in Perth, seems like the Perth market is getting cooler. Whoever we bought this year, do you think there will be any more growth left? So I think this seems like a very fight or flight type comment, and I can resonate with it for sure. So the Perth market is incredibly hot. Like it's cooler than maybe 2 months ago, but that's like saying, okay, it's not at 100 degrees Celsius, it's at 80 degrees Celsius. Like 80 degrees is still going to burn you, right? So that it's still rising. Days on market is still the same as what they were a few months ago. It's still incredibly hot, still running at double-digit price gains. It is slightly cooler, and that's because some suburbs have like doubled. You can't just forever go up at that rate of growth. And also, just to clarify, I didn't say not to buy in Perth, but rather um, that it's a higher risk proposition. And in fact, once again, in the August mentoring calls, there was still some suburbs that I mentioned in Perth, but for a particular strategy. For example, they were more around the 800K mark, and they had a lower yield. So, it's not for everyone's strategy. So hopefully that gives you a bit of yeah, if you bought there, you followed data this year, don't worry, like it's gonna do well. Um, Tammy, hi all. I realized that when we put an offer, there's always the final offer. This is always the final offer in hottest suburbs. This makes it a bit hard on doing the CMA. Do we need to put our best and highest offer as we can? Yeah, I've said that many times, Tammy, a really good thing that you pointed out. In a super hot suburb, you do your CMA. Your CMA is not going to be like perfect. It's a highly subjective thing, and that's really the can be. It's just the nature of what a CMA is. You might have got it wrong, but if you put in your best sort of foot forward and you miss out, then that's a really important data point. And so for the next property, you can say, all right, well, I didn't index enough. Clearly, someone outbid me, so I need to increase it. And so that way, uh, just by putting it in a few offers, just by being in the market, you can understand the market. You can do all the suburb selection, you can do all the data analysis, but there's something to be said of like just being in the market, like taking action to understand that sort of, final step, that final mile, and then getting it over the line. So, like I think most members, they fail, quote unquote, on a number of offers before they succeed, but that's not really failure. Like that's just what it takes. That's part of the process. So I would, yeah. Hopefully that answers the question. Chen, real estate agent didn't give permission for rental home open prior to settlement. How do you approach it to be able to reduce the gap to get tenants? Property is ready but unable to advertise or home open for leasing. Yeah, I mean, sometimes they do, sometimes they don't. Um, the best thing that you can do in this situation is get your property manager primed. You've already got your agreement signed with the property manager. You can get them to appraise the property ahead of time. You can give them the exact address, exact date where the settlement is. Make sure they've diarized in their calendar to go out the next day and like do the take photos for like the condition report. And sometimes they can just reuse the photos that were on the website as I teach in the course, so they don't need to take new photos. And then basically as you settle, it goes up on real estate and domain for tenants. So yeah, that's basically what you can do. Mihir, Does international investing in property make sense at the moment, knowing that there are many payment plans by which you pay down the property within 4 to 5 years, and this is a good cash flow? Of course, as Australians, we might have to report income back to ATO, but are there any exceptions around it? And if we are going to report to ATO, then we take advantage of negative gearing. So what I'm talking yeah, I would say, Mihir, this is really not my area of expertise. I don't want to give any bad advice. I do have property overseas. I have a property in India, and I won't sort of spoil it, but in the US, we're just about to do something as well. But I'm definitely not an expert in international investing, and I don't want to give any tax advice when it comes to TO, etc. Um, so yeah, sorry about that. Um, Rahul, what are your thoughts on the surge of number of investors, buyers agents starting to follow data-driven investing approach in the last few years? Over the coming years, I see this trend growing and perhaps create sudden unsustainable increases like 20 to 30% per year. Does this artificially inflate prices mainly due to high investor activity following the same data investing approach? So it sounds like you've watched that YouTube video from our friend Reedham, who I had on these Tuesday calls. I think he came on a month ago. And I also liked how Reedham did point out that PK clients are ahead of the curve. So I think it's, yeah, this is definitely something that's going on. I think we live, hopefully, in a free market environment where yeah, this should be allowed to happen, you know. There should be allowed to, you should be allowed to optimize and have the highest amount of efficiency in your property investing. Does it artificially inflate prices? My experience, for what it's worth, is that none of the areas that we've really been buying in over the last 5, 6, 7, 8, 9 years as in clients have really fallen more so than they ought to. Every location booms, and then every market, every location in Australia, as per natural property cycle theory, then has a correction. You know, it might go up 40, 50, 60, 70, 80% over the period of time, then it comes back 5%, 10%, 15%, then it plateaus, there's a period of consolidation, and then the cycle continues. I haven't seen to date any location where it's gone up 40%, then dropped 40%, or gone up 80% and dropped 80%. And one thing that really insulates us is that we really want to be buying in locations where the owner occupier percentage is strong, and that's taught in week 2 of the course. And we also want to be buying in locations early, and that's why we have that 50% metric. We have so many other metrics as well. I mean, there are people buying in Adelaide right now, and in places like Morphett Vale, where, for those of you who've been in the course for many years, you know, those locations where you bought in 1920 have more than doubled. Now people are still buying in those locations. So that's what you shouldn't do, because that is a recipe for, you know, prices to go down. But I think it's a good point you raised, Rahul, and I don't I don't think they're artificially inflated, because a lot of these locations also have terrific yield. And so even if the economy goes south, you know, it's not like buying a $80,000 a year negatively geared property in Sydney speculating on house price growth. You know, these properties don't really cost much to hold. And so there's not going to be like huge fire sales or anything. And the people who live there, they're oftentimes the most insulated from economic disturbances, because they're not, you know, in high risk roles to start with, or they're not like in some premium locations, you know, they haven't bought like a $5 million property based on their business wealth or the stock market assets that they have. What you actually find over the last 40 years is properties that are affordable have less volatility than properties that are, let's say, over $1 million. So I think it's something that it's a phenomenon that's occurring for sure, but I'm not really concerned about it insofar as our investing goes. Um, yeah, thanks, Rahul. Gautam, hi PK. If a property I'm purchasing has an existing tenant, then does the bond already paid by the tenant to the existing rental agent, not the PMA agency I'm going with, need to be adjusted by the solicitor in the settlement amount. No, I don't think it does. I think the bond is a separate thing. It's, you know, it's held in a different trust, not the trust that you have with the conveyancer. Also, do I need to include a special condition in the contract for the same? Not to do with the bond, but you might want to include a condition. Like sometimes I've included a condition where the tenant might be like moving out in a month, and in my contract for sale I've included in the special conditions box that they will extend their tenancy by another year. And so then the existing owner investor, you know, negotiates that with the tenant, and then the property comes with that extension. But you don't have to do that. You know, it's better you do that yourself with the tenant, because then you can correctly price it. The old investor or owner may give them a discount more than necessary. So yeah, not to do with the bond specifically, Gautam. Vivek, you're asking about land to asset ratio. Showing 30K value. I think Deepak has basically answered that question as I would have. So yeah, I won't redo that. Nishan, how do you use the losses that happen in a trust? Can you use it to offset capital gains when you sell, or only when trust becomes profitable? Is there a number of years in which the losses in a trust need to be used by? Oh, there's a lot of accounting questions. I'm just going to play it safe and ask that you ask your accountant these questions, because you know there's different types of trust, and then I'll have to answer it per the type of trust and the type of loss. I mean, there's obviously no negative gearing in it. You can't offset your own personal income if you've got an asset in a trust, but the losses do balance versus the income in the trust. And yeah, but there's a lot of tax. I am not a tax accountant, so I don't wish to sort of palm this question off, but I genuinely think it's best you get personalized advice on this one from the accountant. Catherine, hi PK. I'm doing suburb research and narrowing it down to two, but they are in the flood zone. Does it wipe out these two options? Should I go with the next suburbs? So, two things I'll say, Catherine. Best to have more than two suburbs, especially if you're looking at like hot markets. Try to have like, I know I say 2 to 3 in the course, but if you are looking at hot suburb, maybe have like 6, 7, 8 suburbs in your final shortlist. You know, cast your net wide. That way you're about to catch a fish faster. That's one question that you didn't ask. But the thing that you are asking, flood zone is a week 3 consideration. It's an intra-suburb factor. We don't rule out a suburb just because it has some flood zone. We just look at which areas don't have a flood zone in that suburb as per week 3 and look at them. So yeah, it's not something to rule out an entire suburb for. Given the inflation over the past few years and the general price increases across Australia, what are your thoughts on the average investment value of properties? Do you think the ideal value is still below 500K despite the limited supply in that price range, even in remote areas? So in the course, I say that, you know, we want to be buying in locations under 700K. That's what I put in week 1 of the course. I think I put 700 or 750. I can't remember exactly. Those are still plentiful and those are still abundant. And yeah, there's hundreds. So don't worry about that too much. When the time comes, then I'll let you know that we need to shift the goalposts, but that's probably years away. Is there any resources or information about commercial property development in this course or community? Yeah, sorry, commercial and property development's not covered in the course. There are other courses on property development. Some of them cost like up to $40,000. They have like personalized mentorship. Property development is like also a big thing. Uh, there's land subdivision, there's commercial, there's townhouses, there's duplexes, there's like a whole bunch of things in that remit as well. Every council has its own set of goalposts. You know, every council has its own political nuances you need to understand to get development approval, etc., etc. It's its whole entire course. Hi PK, this is Viru. Question regarding list of Townsville suburbs under 500k. These suburbs have grown more than 50% in the last 36 months, e.g. Aitken Vale grown approximately 55%, etc., etc. Do we need to start looking at other suburbs that haven't grown over 50%? Or is this because the price before? No, yeah. If they've grown more than 50%, like, and you've triangulated that, sorry, the sun's like coming right on my face right now. If you've triangulated that with on the house, DSI, SQM, and the triangulation tells you it's grown more than 50%, then just move on. Yeah, that's the best thing to do. And I genuinely think, Townsville was very much the next Perth, like a year or two ago. I think it's probably the last vestiges of good investment opportunity in Townsville, but I might be wrong, but I doubt we will still be investing there in sort of maybe 2025 or at least mid 2025. Let's see how quickly prices grow and what suburbs are remaining. But yeah, it's definitely towards the last stages of our investing there. That doesn't mean other buyer groups won't continue to invest there, just like we stopped investing in Adelaide in 22, I think. Yet many buyers agents, many other buyer groups, many other individual investors still buy in Adelaide right now. So yeah, that's how it sort of fares, generally speaking. Do you have a model we can use to know if a property which is negatively geared is better off to be sold and buy something else? So data, I imagine, includes rent, loan, capital growth, rent increase, rate changed. So Andrea, sorry, the way to do this is through two methods. First of all, we have to split out the cash flow versus the capital growth. Those are two different things. You use the portfolio budgeting tracker as given in week 1 of the course to understand the cash flow implications in exactly how much it's costing you. And in terms of capital growth or lack thereof, or perhaps there might be there, that's what you use week 2 for. Okay, so week 2, I provided you the tools and templates and everything like that. So whether to buy a property or sell a property, they're just two sides of the same coin, the same data coin. So you use the method that I teach in week 2 to make selling decisions as well. So hopefully that makes sense. When considering townhouses, what's considered a large complex? Is it 5 or less townhouses in the complex? I've normally given the sort of guidance that if it's under 8, maybe stretch it max to 12. That's the largest. Ideally you want to be buying in those kind of 4-packs, 6-packs. But yeah, over 10, 12 definitely don't want to have a cookie cutter one where there's always going to be lots of competition for identical housing, basically. Okay, last few questions, guys. Any recommendation of good suburbs in Brisbane with a radius of 25k from main Brisbane CBD under 700k? I think I covered a bunch of townhouse locations in the August quarterly update in top suburbs. I can't remember what those were. I think maybe one was Brendale. I can't remember exactly. Brendale, which is kind of near Strathpine in the northwest. I think that might be one, but I can't remember. Go back and check out that August quarterly update on top suburbs, and there was a few there in Brisbane. Obviously, the yield was much lower. In terms of age, Gautam, yeah, I mean, this is generally it's supporting my argument of not buying brand new properties. So don't read too much into it, but rather we don't want to be buying brand new properties for obvious reasons, land to asset ratio, etc., but also the fact that the build quality is just very poor these days, unless you've got some sort of custom builder and you've built it yourself as a principal place of residence. And so we'll see this in 20 years time and 30 years time and 40 years time. 30, 40-year-old properties won't be as solid as 30 or 40-year-old properties right now. That's simply, yeah, that's the truth. Okay, last couple of questions. I'm looking to buy in Townsville and looked at a property in Mount Louisa, spoke to an agent. He suggested I could be ready to pay 10 to 20% more than asking price. How do I negotiate based on my CMA analysis, or should I walk away from that property? So I think the first thing is like asking price, irrelevant, doesn't matter. Sometimes the asking price is more than the CMA, sometimes it's lower than the CMA. Don't make your point of reference based on someone else's expectations. Make your point of reference based on the truth, which is what the CMA is telling you, an index CMA. So if you're using a 3-month-old sale for your CMA, then make sure you acknowledge that Mount Louisa might have grown $70,000 in the last 3 months, and therefore add $70,000. I just made up that number, by the way, to that 3-month-old property sale price to figure out what your CMA is. That's called indexing, and use your CMA to make offers. Okay, last question from Eli. Hi, PK. This is Bianca. I'm new to your course, just a week old. Or welcome, Bianca. I'm unable to work out how to DM or contact clients like Imish or Prashant through the community forum. Thank you. So what you can do is you use like the @ sign on your keyboard, like, sometimes it's like @gmail.com, that @ symbol, and then you put in their name. And then let's say there's more than one Imish. I don't know if there is or not. Then there'll be like a drop down that comes on, and then you just like click it. And I mean, that's how I do it anyway. Sometimes it can be clunky, and so you just might need to wait like 1 second for the Kajabi community forum to like figure out, who are actually in the course. But yeah, that's how you do it. All right, guys. Well, I think there was a bunch of questions I didn't get to. So if I didn't get to your question, I do really want it to be answered. So please copy paste it into the community forum before you log off, so that I can, honor your time and your question, and make sure we answer it. We answer every single question in the community forum within 24 to 48 hours. It's not like a community forum that, you may or may not get an answer. Every time we give an answer, but of course, you just have to be a little bit patient, 1 or 2 days max. So please use that liberally. Don't worry about bothering us or being burdened, like being a burden or asking silly questions. In fact, I want you to ask lots of silly questions. Silly questions are encouraged. So please, whatever's on your mind, ask it, because I really want to help you and make sure you get fantastic properties, just like, all the ones that I share. Please email me if you do get a deal. I'm really excited every time to find out about those. Please don't communicate with me respectfully. If I can ask on Facebook Messenger or the Facebook group or SMS or WhatsApp, or LinkedIn or X or phone calls or any other method, keep it to these sessions, the private email for like specific properties, or the community forum. If you weren't here from the very start, none of this was professional, financial, or personal advice. Please go back and watch the disclaimer. And lastly, good luck, happy hunting, and yeah, hopefully got a lot of benefit out of the session. I really enjoyed doing the Q&As, and yeah, have a great day ahead. Thanks so much, guys.